Hello, it's Jeff Christian from CPM Group. I'm actually recording this around 5:15 on Thursday evening, 21st of January. We'll release it on Friday morning, the 22nd of January in New York time. The price of gold is trading around $1,860, $1,870 an ounce right now. It rose a little bit on the 20th. Along with the stock market. Our expectation is that the price is going to move sideways for a while here, and we wouldn't be surprised to see the price pull back. You can see here our trade recommendation that we issued yesterday evening, and we were saying that with the price up at these levels, sort of the high end of the range. Gold prices have been consolidating since they came. Gold prices rose sharply January into January 6th. They got up to about $1,960. They came down $145 in 3 trading days between the 6th of January and the 11th of January. After the 11th, the prices were sort of consolidating in a narrow range. They've moved above that range slightly yesterday, and they stayed above that range slightly today. Our view is that the prices could come off. We think that there is a reduction of uncertainty in the world with the change of administrations and the change at the Senate. We think that there is a reduction of risk in markets right now, and that in that environment, gold prices could come back off. Could come back off to 1840 easily. Prices were below that yesterday, maybe even 1820 or 1800 or 1780. The possibility of a technical move called a measured move that could take prices sharply lower cannot be ruled out. Saw that $145 drop in 3 days at the beginning of the month. Prices consolidated. And another $145 drop cannot be ruled out at this point. Partly because people trade based on technical analysis, and this is a clear and easy pattern to see. And the clearest, simplest, most obvious technical patterns are the ones that have the most power in across markets because more people see them and more people trade on them. So another $145 drop, which would take prices down to 1720 or maybe even 1700, is not out of the question. We think that any such decline would be a short-term buying opportunity because the reality is that all of these economic and political problems are still here. We probably have a reduction of uncertainty because we have a perhaps slightly more stable government now in the United States. It will be taking a much more aggressive approach toward financial support for the economy due to the economic lockdown. It will probably also seek to reestablish more honorable, reasonable, predictable international relationships. The things that they're saying right now suggest those things. The economic and political and financial market problems are there, but we're probably having a more adult approach toward dealing with them on the part of the US government. That is reflected in a reduction in risk, and that means that gold prices are vulnerable to a short-term spike down. Again, we think that would be a short-term move. Our expectation is that it might not happen. The prices may consolidate around here, and they may still move higher. We wouldn't be surprised to see the price go back and test 1960. It was there 3 weeks ago. It could easily be there again in a week or 2 or 3 from now. You have relatively strong investment demand, at least on an inertial basis, if not on a kinetic basis. And we wouldn't be surprised to see the price rise and get back to 1960 or even $2,000 at some point over the next month or two. But we want you all to be cognizant of the fact that there is the scope and potential for another leg down, partly because of technical analysis and the fact that so many trades are based on chart patterns like that. and also because there is a real reduction in risk, at least on a short-term basis, perceived across financial markets. That's all I have for today. We'll talk to you next week, and we'll see where we are at that point. Take care.